Have you ever looked at a Nigerian stock trading at 3 naira or 5 naira and thought to yourself, this is a very cheap stock. If I buy 10,000 units and it hits 50 naira, I'm a millionaire. Welcome back to my YouTube channel, and if you're new here, welcome to Investing with Chisom, where I teach you everything you need to know about investing. If you're new to the investment journey, you'd likely confuse a low share price for a cheap valuation. However, a share that is going for 500 naira might actually be a massive bargain compared to a share that is at 2 naira, which can be grossly overpriced. Today we are going to be discussing a powerful metric that you need to master, known as the price to earning ratio, or popularly known as the PE ratio. We are going to talk about what it actually means, how to calculate it without a finance degree, how to compare banking stocks on the NGX, and how to spot value traps and hidden gems. If you want to stop guessing and start valuing like a pro, hit the like button, subscribe now, and ring that notification bell. Let's get into it. Let me clear up the biggest misconception most people have. Share price does not equal company value. Imagine you go into the market to buy palm oil and you meet the first vendor and they are selling to you a plastic bottle of palm oil for 500 naira, but it is watered down. And then the next vendor is selling you a massive pure keg for 10,000 naira. How do we know which one is cheaper per liter? We won't know until we look inside, right? Exactly. That's exactly how the NGS works. A company might be 5 naira, but it actually has a massive amount of shares floating around in the market. So compared to its tiny earnings, it has a lot of shares. Well, on the flip side, we can have a share like MTN Nigeria having a high share price because it is an absolute cash cow. So how do we know if a share is cheap or expensive? We have to look at the profits you are getting from the naira profits that they are giving to you. So that brings us directly to the PE ratio. Never judge a stock by its share price. Always check for its earnings. Drop a comment. Have you ever bought a Nigerian stock at a price thinking that it will explode just for you to watch it stay flat? Let's talk about it in the comments. So what is actually the PE ratio and how do we calculate? Don't panic. Math is minimal here. So the PE ratio stands for price to earnings ratio. What is the price? The price is actually the current price of the stock today on the NGX. So that is, for example, 30 naira per share. The earnings, on the other hand, is the earnings per share, which tells you how much profit the company generated over the past year for every single share. When you divide the share price by the EPS, the result is the PE ratio, which tells you how many years it will take for the company to pay back the price you paid for the stock, assuming profits stay flat. So if the PE ratio is 10, it means that the investors are paying 10 naira for every 1 naira annual profit the company generates. Generally speaking, a low PE ratio might mean that the stock is undervalued or that the business is struggling, while a high PE ratio might mean that investors are expecting future growth or that the stock is dangerously overpriced. Okay, we've done a lot of talking. Let's see how to do this in real time. I'm pulling up real data on investing.com for a major tier 1 stock like Zenith Bank. So the first thing I'm doing is I will search for the ticker and head straight to the stock or financial summary page. So I check the current share price against the trailing earnings per share. In fact, let's pull out a quick calculator to see how this magic happens. If we take the current share price and divide it by the earnings per share, the exact calculation gives us the multiple the market is placing on the business. So look right at the PE ratio summary on the platform. For Zenith Bank, we are seeing a trailing 12-month PE of around 4.8 multiple. When you look at its historical 5-year average, which sat closer to 2.6 multiple, it tells us that while the bank's valuation has expanded as profits grew, we have to look closer to see if it is justified or if the market is pricing in stronger future growth. Now we could spend the next hour comparing every other banking pair, looking at how Zen stacks up against ZTCO or Access Holdings to see which bank is offering a better deal for every naira of profit. But to keep this video focused, we are going to keep that for a later video. Pro tip: whenever you check for the P ratio on platforms like this, don't look at it just in isolation. Always go back to check its historical average and compare it to its direct competitors. Drop a comment below if you'd want me to actually go through the banking sector and comparing them. Let me know in the comments. Now, this is where beginner investors make a massive costly mistake. You scan the index, you find a stock going for a P ratio of 2, and you say to yourself, jackpot, this is the cheapest stock on the market. Hold on, why is it so cheap? This brings us to the difference between a hidden gem and a value trap. Let's start with a value trap. A value trap is a stock that looks cheap on paper. It has a low P ratio, but the business is fundamentally broken. It may be drowning with litigation, or it may be losing market share to its competitors, or it could be suffering from foreign exchange loss damage. So the market isn't blind. Investors are intentionally avoiding it. And that P ratio that you see could even stay flat as it is, or it could drop lower as the stock price crashes. So what is a hidden gem? A hidden gem is a fundamentally sound, highly profitable company that the market is temporarily ignoring due to short-term market panics, regulatory noise, or seasonal sector dips. Their earnings are solid, their cash flow is positive, but the market is temporarily ignoring it due to seasonal sentiments that are suppressing the stock price. So how do you tell the difference? You do this by combining the PE ratio with deeper analysis of the fundamentals like the revenue growth levels, the debts, and the cash flow. And don't worry, in my next video, we are going to be breaking down the exact steps to do this. So you don't want to miss it before you put your hard-earned money down. Understanding the PE ratio transforms you from a gambler chasing flashing red and green tickers into an intelligent investor buying real operating Nigerian businesses. Remember, price is what you pay, but value is what you get. So if you found this video valuable, smash that like button and drop a comment below telling me what Nigerian stock you'd like me to break down for you doing evaluation, and subscribe so you don't miss the next video. Thank you for watching and stay smart with your investments. I'll see you in the next video.